I told you that buying your first home could cost you thousands more than it should, simply because no one explained the process clearly. Most people dive into the market excited and unprepared, and they end up learning the hard way. If you want to save money, avoid mistakes, and buy with confidence, stay right here. With over 23 years of experience as a real estate agent, I'll walk you through everything you need to know before buying your first home. By the end, you'll understand how to budget, get pre-approved, find the right property, close a deal smoothly. Whether you plan to buy next month or next year, this is your foundation for success. And hey, make sure you watch till the end. I discuss the 4 biggest mistakes to avoid. All right, let's start with the first and most important step, knowing what you can actually afford. Too many buyers start browsing listings very excited instead of building a budget. You gotta figure out your real number. Take your total monthly income, subtract all the regular expenses like insurance, car payments, groceries. The general rule is you keep your housing costs, including mortgage, property taxes, and insurance, below 30% of your gross monthly income. Your credit score also plays a huge part. It determines not only whether you get approved, but how much you pay in interest. If your score is above 740, congratulations, you're in great shape. If it's between 700 and 739, still get some pretty solid rates. Anything lower than 700 might be worth taking a few months to improve it before you buy. Every point that you raise could save thousands over the life of the loan. And remember, you'll need more than just a down payment. Plan for closing costs, which usually are 2 to 5% of the purchase price, and a small emergency fund for the unexpected. Now let's talk about mortgages, because this is where many first-time buyers start to feel lost. A mortgage is simply a loan that allows you to buy a home and pay it over a certain amount of time, usually 30 years. But not all mortgages are the same. A fixed-rate mortgage has the same interest rate for the life of the loan. It's predictable, which makes it ideal if you plan on staying in your home for many, many years. An adjustable rate mortgage starts with a lower rate that can change later, usually 5, 6, 7 years later. It's riskier, but if you know that you're going to sell within a few years, it can save you some money early on. Then there are loan types. The conventional loans are for buyers with good credit and solid income. FHA loans are designed for first-time home buyers requiring smaller down payments, usually 3.5%. VA loans are for veterans or active military. And USDA loans help people buy in qualifying rural areas with little to no money down. But before you start looking at houses, get pre-approved with a mortgage lender, and I have recommendations I'm more than happy to give you. That tells the sellers that you're serious and helps you know really what your price range is. All right, congratulations, you're pre-approved. The fun begins finding your home. Start by making 2 lists, one with your must-haves and one nice-to-haves. Must-haves might be the number of bedrooms, the commute time, or location. In Florida, probably something about not being in a flood zone. Nice-haves can be granite countertops, a big backyard, or a 2-car garage. It's always great to work with a buyer's agent. A good agent represents your interests and not the sellers, and they usually get paid by the seller's commission, not by you. They'll guide you through the process, negotiate on your behalf, and catch details you might miss. Of course, if you need any help, I'm always willing to assist. All right, you found the right house and it's time to make an offer. Your offer includes the price you're willing to pay and any conditions you want met before the deal is final. These conditions are called contingencies, and they protect you. An inspection contingency lets you back out or renegotiate if the inspection reveals major problems. A financing contingency gives you an out if your loan fails. A financing or mortgage contingency gives you a way out if your loan falls through. And an appraisal contingency ensures that you don't pay more than the home is actually worth. It also includes something called an earnest deposit or earnest money, which is a small amount of money, usually in Florida, $3,000 to $5,000, to show that you're serious to the seller. All right, woohoo! Your offer was accepted. 2 important things: the inspection and the appraisal. The home inspection checks the property structure, the roof, plumbing, electrical systems, and more. In Florida, we have something called a 4-point also. Always hire a qualified inspector. If issues come up, you can request repairs, a price reduction, or seller's credit for you to fix things after closing. The appraisal is for your lender. It confirms the home's value so the bank knows it's a good investment. If the appraisal comes in lower than the offer, you'll have to renegotiate or cover the difference in cash. Now you finalize your mortgage, get all the paperwork to your mortgage lender. Once everything checks out and you lock in your interest rate, you'll get a clear to close from the mortgage company. Just make sure you don't do any large purchases before closing, like buying a couch or getting a car. And finally, it's closing day. You'll do a final walkthrough at your home. This is your chance to make sure any agreed repairs are done and that the property is in the same condition as when you made the offer. At closing, you'll sign the paperwork, probably at the title company, pay your down payment or closing costs, and officially get the keys. If you're still with me now, let's talk about what happens after you move in. Budget for ongoing expenses like property taxes, insurance, HOA fees, and maintenance. Sometimes as part of your mortgage payment. Set aside about 1% of your home value each year for upkeep. Want to pay off your loan faster? Make one extra principal payment each year, and that can save you thousands over the loan period. All right, so tell me in the comments what part of home buying process worries you the most. Is it the credit score, the down payments, choosing the right loan? Your feedback helps shape future videos that answer real first-time buyer questions. And if you like this guide, click the like button so more buyers can find it. Now, back to the important part of avoiding the biggest mistakes. Here are 4 to watch for. The number 1 is don't buy more house than you can comfortably afford. Just because a lender approved you for a certain amount of money doesn't mean that you should borrow all of that money. 2, never skip the inspection. It might cost a few $100s, but it could save you tens of thousands later. Avoid making financial changes during the loan process. I talked about this a little bit earlier. Keep your account stable until the keys are in your hand, aka don't buy a new couch. And finally, don't let emotions drive your offer. The goal is to buy a home you love, not one that drains you financially. I hope all this has been helpful. If you're looking to buy, sell, or invest in real estate, as always, remember to call Paul. Have a great day. Bye-bye.